You guys do anything exciting this weekend?
Ran to Crescent.
You ran to Crescent?
Ran to Crescent.
And back?
And to Gallitzin and back here.
Hell of a run.
You were on the side of the road?
Oh yeah.
You didn't get hit?
No.
Not even a little bit?
How do you get hit a little bit?
Just his left just a bit, you know? Maybe with your finger. His tail gets run over. I would not run on that road.
The worst part is by the playhouse there, the Crescent Lake Playhouse.
Oh, yeah.
It gets really narrow. But other than that, it's pretty fun. I'll say wait. That's fine.
Did someone almost hit a runner on the way to Crescent? All right.
Just a little bit.
All right, so today we're gonna finish up with these, I don't know, this intro stuff, and then we'll get into econometrics. So I think this is where we left off last time. So the difference between money markets and capital markets: money markets deal in short-term debt instruments, and your capital markets are gonna be longer-term debt and equity instruments. So money markets are, like short-term bonds, mostly like government treasuries. Just like the treasury bills. And the capital markets will be like treasury notes and treasury bonds. Notes is the middle maturity, I couldn't remember last time. And then equity instruments, stuff like stocks. So here's your money market instruments, like so treasury bills, negotiable bank certificates of deposits, so like large denominations of CDs that people keep in banks, commercial paper, and then federal funds and security repurchase agreements. So federal funds, that's the reserves that banks have to keep on hand at the Federal Reserve so that they maintain a certain buffer of funds that they have to pay out depositors in case there's a run on the bank. And security repurchase agreements, it's another tool of monetary policy that the Fed uses where they purchase assets from a bank with the agreement that they're going to repay the bank back later. So they may do it like overnight, so maybe like a 24-hour one or maybe slightly longer window. And they also have reverse repurchase agreements, which is like the opposite way. That's just another tool that the Federal Reserve uses besides the interest rates on keeping the federal funds in the Federal Reserve. Then the capital market is just a list of all the different types of instruments from corporate stocks and mortgages to corporate bonds, government, longer term debt, commercial loans, consumer loans, and like different types of mortgages. And if you go to the Federal Reserve website, they have a list of like where they get the amounts for all these loans. They'll show you just how much like all these instruments, how much of them are outstanding. Skip some of this internationalization because that's not something we're really going to get into in this class. So what exactly are the function of financial intermediaries? Like what does indirect finance, how does this help the economy? It's not just a chance for big banks to profit off of people. It actually does serve a function. It lowers transaction costs, so there's a lot less time and money that people spend trying to invest, trying to make loans, or trying to receive loans. And make the process a lot simpler. One of it is economies of scale. That they have people who, that's all they focus on. So because they do it a lot, they have. They can do it much more efficiently than someone who, say, very rarely does it. They know the right people to contact. They have all the software they need. And they also provide liquidity services. So liquidity is the ease of transferring whatever type of asset or property you have into money. Some things are very liquid, it's very easy to sell, like relative to their value. Some things are illiquid, it's very difficult to try to find a buyer. So like a house is gonna be very illiquid, but like a common stock is very easy to sell to someone if you need to get money quickly. They also provide risk sharing. So in the run-up to the financial crisis, a lot of financial institutions held mortgage-backed securities in order to lower their risk. What they did is got a different type of asset called credit default swap, which allowed them. It was like buying an insurance policy on the mortgage-backed security, so that if people didn't repay their mortgages, if they defaulted on those, then if enough of them happened and like they weren't able to get paid mortgage-backed security, they had like an insurance policy, so they would get paid by whatever third party agreed to do this. I mean, AIG wrote a ton of them, and that's one of the reasons why they got in trouble during the financial crisis. But they do other types of risk sharing, or allow for other types of risk sharing that doesn't, lead to economic catastrophe. Also allows for diversification. Obviously, diversification is good. If it's 2006, 2007, and you're pretty much only exposed to mortgage-backed securities, you're going to be in trouble. But if you've got a ton of different assets, you're much less exposed to the downside risk in one of those markets. Likewise, if you have all your assets in like emerging markets and like stocks from those countries, and a couple of those countries, something goes terribly wrong, maybe the government gets toppled or they just have like their own financial crisis or something, if you're only exposed to them, you're going to be in trouble. If you've got like U.S. stocks, or you've got some U.S. government debt, some precious metals, all spread out into many different things, you're more likely to be okay in a situation like that. And they also help deal with asymmetric information problems. Asymmetric information is when one side of the transaction has more information than the other side. So a common example we use in economics is just like the quality of the goods. So say you're going to buy a used car. The greasy used car salesman, short, bald guy, bad, like loud plaid jacket, like Danny DeVito, basically. He knows exactly how crappy this car is. He knows the engine's about to fall out. But you looking at the car, you don't know. That's asymmetric information because you have much less than the used car salesman. In this case, these financial intermediaries, they gather as much information about the person as possible, about the borrower, so so the other party would know if they're risky or not. If the person has a history of like defaulting, or if they have low income, maybe they work in a super risky field where they could get laid off at any time. These are things that the bank would want to know so they could try to figure out how likely they are in repaying the loan. They also help deal with moral hazard. Moral hazard is when someone is encouraged to, like the incentives line up that they would engage in more risky behavior. So say you get insurance, you have health insurance now. You face a moral hazard that because you're covered in the case of of bad health outcomes, you can be more risky. So you can whether you start like mountain biking, obviously much more risky, like break bones, you fall off or something. Maybe you start smoking, or you eat less healthy because it's covered if there's a problem. That's the idea of moral hazard. And in this case, these financial intermediaries, they help ensure that borrowers don't engage in this sort of stuff. They don't take more risky financial behaviors that would prevent them from repaying the loan. So they sign a contract that they call restricted covenants, prohibiting them or limiting them from doing certain activities too much so that they're more likely to repay the loan. And according to the textbook, financial intermediaries allow small savers and borrowers to benefit from the existence of financial markets. So if you wanted to get a smaller loan, or if you obviously borrow money a lot more rarely than than a large company, it's easier for you to get into this market rather than having to go around and looking for friends or family or someone in the community to borrow from. You've got a financial institution that you can go to. Here we have all the different types of financial intermediaries. You have depository institutions, so these are banks, savings and loans, which you almost never hear of anymore, credit unions. Basically, you put your money into an account there, and they make money by turning around and lending it out. And all four of these are basically the same, from commercial banks down to credit unions. They're very similar, but a little bit of the structure is like slightly different. We don't need to get into that, but and there's like contractual savings institutions, so things like basically different insurance companies and retirement funds. Next is investment intermediaries, so finance companies, mutual funds, money market mutual funds. All different ways to save money and try to grow your investment. Hedge funds are considered riskier, so you need to have a certain amount of assets in order to get into a hedge fund and actually invest in it. I forget what the figure is, but it's pretty high. They keep it only for like rich people that they think can withstand a loss. And most of the really rich, they use it to hedge against losses somewhere, which is why it's so risky. And this just shows what the value of the assets of these different financial intermediaries. So you can see their relative size. So like credit unions. So I guess they're basically $1 trillion of assets in these. In credit unions, commercial banks have 12 trillion. So you can see the relative size. There's far more commercial banks than credit unions out there. You can see there's a lot of money in mutual funds compared to the other investment intermediaries. All right, so the financial system is the most heavily regulated area of the U.S. economy because there's so many risks involved. The government has seen it prudent to design regulations in an attempt to protect consumers from all the things that can go wrong. So some of the things they try to do is reduce adverse selection, to keep real risky people from borrowing funds that they can't repay, preventing moral hazard for individuals borrowing and for like the firms, corporations that borrow. And they want to try to reduce insider trading. That's primarily the SEC. That's people like within a company that have knowledge of something that's going to happen, that's going to affect the stock price or something, before the public has a chance to know this knowledge. So famously, Martha Stewart got in trouble for that, probably like a decade ago now, and she actually went to jail. I don't remember what the exact information was. Maybe two companies they were talking about merging and it fell through. And then that's it. Insider could short it before that went to the market, or sell off all the stock they had when it still had a high asset price. Then obviously they'd make a lot more money compared to people that didn't know and would hold on to it until after the news broke. So these are different types of regulations. There's obviously tons and tons of regulation, but the basic buckets that they fall into. Versus there's restrictions on entry. In order to become, especially like a commercial bank, if you want to become a commercial bank, you need to get chartered. Originally, it was the states that would charter new banks, and then after the Civil War, the federal government also began chartering banks. So if you look, I don't know, there's First National Bank is a bank around here. They were chartered by the federal government. Then I can't think of any state banks around here, but there's a lot of banks. What?
Town Bank.
I don't know that bank.
I'm pretty sure they're a state bank.
A lot of them will have state in their name, Like there's a town near where I grew up called Jersey Shore, and there was a Jersey Shore State Bank. And when I was a kid, I was confused. Like, that's a city. Why does that have state in the title? But that's because they received a state charter. They also require disclosure of information. So if you get, one example is prepaid cards, like little credit cards that you put money on ahead of time, put onto there. They require a lot of information to be disclosed about the interest rates, about penalties and fees, all that sort of stuff. If you open up like a new account at a bank, they have to give you all these forms, basically explaining what's going on. Again, interest rates, fees, trying to make sure that the consumer knows everything that's going on, all the requirements and responsibilities that they have. They have restrictions on assets and activities, like I mentioned with hedge funds. I know I don't have enough assets on hand to be able to invest in a hedge fund. There's deposit insurance, so the FDIC, the Federal Deposit Insurance Corporation, they insure bank accounts up to, I think it's over $200,000 now. So if there's a run on the bank and banks don't keep enough money on hand, the FDIC will pay the individual up to whatever that limit is, say like $200,000. So you're guaranteed to have that. The purpose of that is to prevent runs on banks, because if you know the money is there, then you don't have to run in and take it out before the bank collapses. And finally, there were limits on competition. Most of these they've gotten rid of, but there was a prohibition on branching for banks, so they couldn't open up a second branch. So there used to be a bank in town. S&T was on Main Street. In the past, when there was branching prohibition, they could only have that branch there. Obviously, you can see the problems with that, with not being diversified. That if, say, everyone that lived in town worked at St. Francis, they St. Francis lays off like half the workforce, that bank's in serious trouble because half of their depositors are screwed. Or say it's in a farming community and there's a really bad harvest. If all the farmers default on the loans they have with the bank, that bank goes under. There are also restrictions on interest rates, usury laws that prohibited charging interest above a certain amount to prevent people from being taken advantage of by banks. The problems with that was that extremely risky individuals couldn't get loans, and these usury laws were not, they just picked a number, they said above like this percentage, but when there was massive inflation in the 70s and 80s and interest rates spiked, a lot of people couldn't get loans because the ceiling, or the restriction, which was super high in the past, became a lot lower, because if the prime interest rate is like 13%, and banks charge above the prime interest rate, they say so much above that. If the ceiling's at like 17 and the prime rate's at 13, there's not much room for you to go in there to actually sell loans. So people that weren't bad risks were being prevented from getting loans, which is why they got rid of a lot of those restrictions. This table is going to show a lot of regulatory agencies that are in charge of regulating the financial market. There are a ton of regulators, and they all have different areas that they carve out. There's some overlapping between the two, or between different agencies, and some just have their own little area. There's things like the SEC, Securities and Exchange Commission, Commodities Future Trading Commission, Comptroller of the Currency, Credit Union Administration. There's state-level regulatory agencies that oversee financial institutions. The FDIC, like I mentioned, the Federal Reserve System. While they're primarily engaged in monetary policy, they also are in charge of regulating some things as well in the financial system. Dodd-Frank regulation that was passed in response to the 2007 crisis gave the Federal Reserve a lot more regulatory authority. So a lot of their regulatory responsibilities are rather new. Okay, and that brings us to the end. There are several more regulatory agencies that are in charge. Theo Brook-Knight from the Cato Institute had a really good piece just showing specific instances where there were upwards of like 8 or 10 regulators that could oversee one financial institution's activities. So there are quite a bit of regulators with all different authorities. Instead of just a system where there's just one regulator tasked with overseeing the financial system, we've got a ton of smaller ones with little carve-outs. You guys have any questions about financial system, any of this junk? If not, then we'll jump into econometrics. Now for your paper, you're going to be, one of the components of it is using econometrics to try to understand what the effect of whatever your policy question is. So this week, maybe a little bit into next week, we'll talk about econometrics, go over the basics. How many of you guys in here have had econometrics before? In sports econ? Just to note, sports econ is a combination of obviously like talking about sports topics, but it's also your intro to econometrics. I didn't know that when I was an undergrad, so I put it off till the end because I thought it was just going to be like a blow-off class. Then I found out that's where you learn the basics of econometrics. So way too late. But the reason Timmons picked sports is because there's so much data out there for sports that it's really easy to design a project. There's some stuff that we do that economists try to do that there's just no data for. So it makes trying to design these models really difficult. But in sports, it's a lot easier. How many people have a background in like statistics? Taken statistics class here? Miko's QBA, or was it like statistics with the math department?
It's with the
Okay.
department.
Okay. Okay, so you've got a pretty good background. All right. I'm not going to really get into the hardcore math behind this, or like set notation or anything like that. Basically, just enough knowledge that you know like what these models are and how to use it. I'm also going to have another economist, one of my friends, come up and go through how to use Stata for a class. I'm not sure when that's going to be yet. It might be after we're done with this section. But he's a real good whiz. He can like code this stuff in his sleep. People like Timmons and I, it takes us a little bit longer to do this. And one of the things I learned, I had numerical analysis when I was here. And we used MATLAB for that class, and we had to write code for it. And we'd have like a lab where we'd like sit down there, like we're all on computers somewhere in the science center, and we're just coding away trying to design Monte Carlo simulations or stuff like that. And I'm way out of my sorts here. I'm not prepared for this. And then I saw the professor, she's like, oh, I can't figure out how to do that. And she just went to Google, typed in like MATLAB, how to code this. And like the answer popped up. And that's a lot of coding, that's what a lot of coding is. It's like, oh crap, I'm getting an error, I can't figure this out. So you just type it into Google and like find a Stata help list. And someone else had that problem before already. And you see how someone walked them through it, what to do, and then you do that for yourself. So when we get to the Stata coding part, don't feel bad if you don't understand what's going on, if you don't know what to do when you try and do it for yourself, because that's what everyone does. No one has it all like memorized. Okay, so economics suggests important relationships. Using theory, we can understand how things relate to each other, develop a story, but often, especially when we're looking at public policy, and you want to actually determine what the effect is, you want to test whether your theory holds, and then try to estimate what the actual effect is, you need something more than just a theory. So econometrics is the use of statistics to try to estimate the quantitative effect of whatever relationship you're exploring. So these slides came from Stock and Watson's Intro to Econometrics textbook. The example they use is what is the impact of class size on student achievement, and that's like their running example throughout. So when we talk about examples through here, it's going to be that. That's not, I don't know, not monetary policy stuff, but I still think it's a good example to try to actually put variables in this instead of talking more theoretically. But there's a lot of other, they list some other examples. How does an additional year of education impact a person's earnings? What is the price elasticity of cigarettes? We can use econometrics to estimate that. Here's a monetary policy question. What is the effect on output growth of a 1 percentage point increase in interest rates by the Federal Reserve? And what's the effect on housing prices of environmental improvements? All of these things we can use econometrics to not just test whether our theory holds true, but we can actually estimate what the effect is, so we could put a number to it. So what Timmons and I specialize in is occupational licensing. So we try to, obviously the theory says that these laws restrict competition and restrict entry, so that's going to increase the wages for professionals. I mean, we could say that until we're blue in the face and just talk about that theory, but people don't really care about that. If we do, so a lot of our studies focus on using econometrics to estimate what that actual effect is. So we can say for radiologic technologists, they have between a 9 and a 13% increase in wages because of occupational licensing. You could say dentists have, say, a 25% increase in wages due to occupational licensing. And actually putting a number to that makes it a lot more meaningful than just saying theory suggests this will happen. Okay. So we're going to be using data to try to measure the causal effect. Ideally, we'd like to do we'd like to do an experiment. This is a randomized experiment is like the gold standard for trying to determine causation and estimating what the impact is. So in science, in psychology, these things, they're often able to use experiments to try to estimate this effect. So if you're trying to estimate the effect of class size on standardized test scores, you could do that with an experiment. However, that's difficult to do in economics. We can't randomly assign people to one regulation and randomly assign other people not to a regulation. Also, there's legal problems with being able to try to do an experiment like this, especially for things like student test scores. You can randomly assign people to an education design that you think is going to be worse, to purposely hurt them to try to understand what the effect is. So we end up with observational data in economics usually. So if you're looking at GDP, interest rates, these are going to be observational. There's no experimentation going on there. So a lot of this course, or a lot of this econometrics that we're going to be talking about, deals with the difficulties from using this observational data, because we can't establish true causation using this data. It's trying to design models that give us the best possible estimation. Now this lists some of the problems here, the confounding effects. So these are omitted factors. If you're trying to estimate the effect of the change on interest rates on output, there's going to be a lot of things that also affect output. And you're probably not going to be able to control for all of them because you just don't have the data. There's also simultaneous causality. This is another problem dealing with macro level data, is that GDP affects interest rates, but interest rates also affect GDP. It goes both ways. So there's tools that we have to deal with that. And then the code at the bottom, the reminder that correlation does not imply causation. There's kind of a funny website, I guess funny if you're a nerd, of different correlations. I think it's the gross earnings from Nicolas Cage movies is highly correlated with the number of drowning deaths in the United States. Obviously, Nicolas Cage starring in a movie doesn't impact drowning in a pool, but there is correlation between those two, and there's a strong correlation.
There was also one that I saw was the one that Tom Cruise runs in Mission Impossible movies.
Are you serious?
Yeah.
It's definitely causation.
I haven't heard that one. I like that.
Per capita cheese consumption is highly correlated with the number of people who died by becoming tangled to their bed sheets.
How many people die being entangled in bed sheets?
In 2009, almost 700.
Wow.
Better watch out the next time I go to bed.
I don't know how you defend against that, besides just sleeping with no sheets on.
I guess I don't. No more sheets.
Okay, so for our empirical problem here, for our example, is class size and educational output. So the specific policy question they're asking is, what is the effect on student test scores of reducing the class size by 1 student per class? We're going to use data, observational data, to try to estimate this effect. There is a way to answer without data. We can do an experiment. But obviously, with education, this isn't going to be an option. So right here is a first passage trying to understand the relationship. It's a scatter plot. On the y-axis, we have the test score, and on the x-axis, we have the student-teacher ratio. And then all the points are for the different schools or different classrooms. You guys see any real relationship here between the two?
Strong downward correlation. Like 0.2.
Yeah, so there's not much of an obvious relationship here. So there's much more to do besides just looking at a scatter plot, but that does give you a good first look at it. So the first thing you can do is what's called estimation. Comparing the average test scores in districts with low student-teacher ratios to those districts with high student-teacher ratios. Next, you can test the null hypothesis that the mean score of the two types of school districts are the same against the alternative hypothesis that they differ. And finally, you can estimate an interval for the difference in the mean test scores for high versus low student-teacher ratio districts. It's called doing a confidence interval. Linear regression, which is what you'll be using for your papers. This lets us estimate the slope of a regression line. So going back to the scatter plot, using ordinary least squares regression, we can estimate a line of best fit going through this data. It does luckily have a downward trend, so it'll be like somewhere like this. And by taking the coefficient from that, we can use it to estimate what a change in the student-teacher ratio is likely to do to test scores. Yeah, so ultimately our aim is to estimate the causal effect on y of a unit change in x. But just initially, we're going to be trying to fit a straight line in two variables. Later on, we'll add control variables to account for the omitted variable bias to try to control for as much as possible, to try to get a more accurate line. But right now, we're just looking at two variables to keep it simple. So this right here is the population regression line for our example. So we have test scores equals a constant alpha plus beta times the student-teacher ratio. Alpha is going to be a whole number. It's a number that we're going to estimate, which is why it has a variable right now. And likewise, beta is the slope of the population regression line. That's going to be what the effect of a 1 unit change in the student-teacher ratio, what its effect is going to be on the test scores. Yeah, we're trying to figure out what the population value of beta is. We don't know beta, so we're going to estimate it using the data. So this is about as mathy as it's going to get. So we have y right here, which is the independent variable. We then have alpha, which is the intercept. So that's where it is going to cross the y-axis, where our line is. X is the independent variable for the regressor. That's our variable of interest. In this case, it is the student-teacher ratio. And then there's U, which is the regression error. So that's basically what we can't account for using the data. We don't include an estimation of the error term in our regressions, but it's something that when we write out the model, we put there. Now the subscript I is the individual unit, like whatever we're looking at. So for student-teacher ratio, it's going to be the classrooms. And the 1 comma dot 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 n is saying that that's the number of units. So say we have 420 different classrooms in our example. This I is going to be from 1 all the way up to 420. Yeah, and the regression error, that's going to contain the omitted factors. So in this case, if there's other things that affect the student test scores besides just the student-teacher ratio, that's all going to be captured in our error term U. Now here's a simple regression model in one picture. There's a lot fewer units than in the student-teacher ratio. In the full example, now this is the basic idea. That we have these data points here, and this is the regression line that we estimate. So that's going to be a line of best fit for the data. The difference between the actual observed point and the estimated line is going to be the error term for that one. So that's an error, that's an error. So our U term is going to be the sum of all those errors. And we want to make that as small as possible by including all these different variables that we can to control for test scores. So the alpha term, I forgot to change this. The slides use the example beta 0 and beta 1 for your variables. I switch it to alpha and beta just to make it more clear, so there's less confusion. So think of this one as alpha. I'll switch it on the slides because it's posted on Canvas. The alpha is going to be, I don't know, about 670, where this crosses the line there. So this doesn't really make sense here, but in general, where it crosses the line, that's where the obviously the x variable is 0. So in this case, if there's 0 students in a class, what do you expect the test score to be? Here it's impossible. Some variable, if you're looking at interest rates can be 0. So in that case, where it crosses the y-axis, that's going to tell you something. Here it's not. So remember, sometimes it's a value, sometimes it's not, depending on what sort of data you're using. So what this equation is saying is that we're trying, for ordinary least squares, our goal is to minimize the difference between, pull up the last one. minimize the difference between the observed points, the actual points, and the line of best fit we have. So minimize the sum of all the squared errors. There's different mathematical methods that we could do to try to get a line of best fit. Ordinary least squares is considered the most accurate one. But the base idea, as small of an error as possible. So something that provides the best fit. And the equation at the bottom is just, it basically saying we're trying to minimize the error. So the population regression line, test in this case, test score equals, I forgot to change this one. Think of it as alpha plus beta times the student-teacher ratio. So beta is going to equal the change in the test score divided by the change in the student-teacher ratio. This is saying what we just said. Ordinary least squares estimator minimizes the average square distance between the actual value of y and the predicted value of y on the estimation line. You can use calculus to solve this by hand. And numerical analysis, we actually did ordinary least squares by hand. And it took, with like 4 data points over 2 time periods, it took like 3 pages of paper just to do one. It was awful. Here you'll use either Gretel, which is free, or Stata, which the school has copies of in the computer lab in the basement. But the result is the ordinary least squares estimators of alpha and beta. So that's what we're going to get from performing the OLS regression. Here we have the regression output for the student-teacher ratio example. With all this data through here, we found the line that minimizes the sum of squared errors to be this line right here. So the estimated slope of the line of best fit is negative 2.28. So for what this is telling us is, for every increase in the student-teacher ratio of 1 student, we see a 2.28 reduction in the average test score. So as you get more students in the class, we're seeing worse test scores, which theory should tell us that this makes sense. That the more students you have in class, the less one-on-one interaction students have with the teacher, the more difficult it's going to be to learn. And now, using the data, we can estimate that for each additional student, we're seeing a reduction in 2.28 points on the test score. Obviously, that's not a great effect because the test score is out of 720, but it's still showing that there's a negative effect. And the estimated intercept, alpha, is 698.9. So if there were 0 students in the class, we'd estimate that they would have a 700 test score. In this case, that makes no sense, but like I said, sometimes the data does go to 0 and below. In that case, it would make a lot of sense. So our estimated regression line written here, the test score equals 698.9 minus 2.28 times the student-teacher ratio. So in this case, if you wanted to try to estimate what, let's say according to our model, if there were 20 students in the class, what would the test score be? You would just plug in the number 20 for the student-teacher ratio and solve, and then you could get your estimation for it. Okay, and that's basically what I just explained. Okay, so one of the districts in the sample is in Antelope, California. The student-teacher ratio there is 19.33, and the test score is 657.8. So the predicted value for y, plugging in the 19.33 in the student-teacher ratio, we get 654.8. So to calculate the error term, that's what they're calling the residual here, is 657.8. So what the observed test score was, minus the estimated test score, 654.8. So we have a difference of 3. That's our error term in this case. Remember, we're trying to minimize the error as much as possible so we have a more accurate model. Now, if you're doing this in Stata, this is what the output's going to look like. Right here, the code is very simple. You just say regress because you want to do a regression. The test score, and the student-teacher ratio. You don't have to use common robust, but that uses robust standard errors, which is, let's say it's better to use. It gives you more accurate output. So we have here, all this down here is what it outputs. So here we have student-teacher ratio. The coefficient is negative 2.279. So negative 2.28 that we found. Here's a constant, 698.93. It gives you the standard error and the t-score, or t-statistic, the p-value, and the 95% confidence interval. What's really going to be important for you guys is the coefficient and then the p-value. The p-value we want to be as small as possible. The p-value is the probability that the coefficient you got was due to random chance, not due to an actual effect. In this case, for both of these, it's 0, which is really good. You want it to be as low as possible. So we say that below 1%, that's strongly statistically significant. 5% is statistically significant, and below 10% is weakly significant. If you have a paper and you're trying to estimate the effect of something, you want it to be as low as possible, but basically if you're reporting results, you want your best result to be at least 5% or below. If you have a paper and you say, oh, we found the effect was this with a p-value of 9%, a referee in a journal is not gonna be impressed by that. So you're gonna have to do better, get it down to like 5%. But it is important to note that sometimes finding no effect is important. You're saying this, this doesn't have an impact. I've done that for some papers before. Yeah, so we'll end there today. Do you guys have